Hello everyone. Welcome to this demo session where we will deep dive into the preparation of a cash flow statement under AS-3 revised. My name is Jagan Devanathan and I will be taking you through this complex yet fascinating topic. We will use a fully worked out case study based on a fictional entity. This example will help us understand not just how to prepare cash flow statement, but also how to classify cash flows under operating, investing, and financing activities, and handle special adjustments like non-cash transactions, interest, dividends, and foreign exchange differences. Now, as per, as per AS-3, a cash flow statement is a statement showing inflows and outflows of cash and cash equivalents during a specified period. There are three main sections: operating activities, which show core business transactions; investing activities, which show purchase or sale of long-term assets or income from investments; financing activities that show capital, borrowings, dividend payments, interest on loans, etc. Now, cash and cash equivalents include cash in hand, demand deposits, short-term, highly liquid investments with a maturity of 3 months or less. Today, we will prepare the cash flow statement using the indirect method for a fictional entity called Sapphire Tech Limited. Now, the following are the balance sheet extracts of Sapphire Tech Limited for the years ending 31st March 2025 and 31st March 2024. Now, they have given you the balance sheet extracts, okay, for the 2 years for comparison to know how the cash has moved from the previous year to the current year. Okay, from that, we have to decode, how much is the inflow and how much is the outflow, and what is the nature of those inflows or outflows, and arrive at the reconciliation as to, what are the net cash and cash equivalents at the end of the year. Okay, now, so we say that equity share capital. So let's go through each item to understand what kind of a cash movement is involved, right? Now, equity cash. So they say that now equity share capital has increased from 10 lakhs to 12 lakhs. Okay. Now 2 lakhs, there is an increase of 2 lakhs from the previous year to the current year, which actually means that there was a further issue of share capital. So we have received 2 lakhs, okay, in cash, right? From the equity shareholders. That is the assumption. Now, 10% debentures, as they have been reduced from 5 lakhs to 3 lakhs, which means that partly they have been redeemed. Now, general reserve from 1.5 lakh to 2 lakh, which means that there is a transfer to general reserve from the previous year to the current year of 50,000. Now, there is a surplus in PNL from 90,000 to 1,20,000. This is a change in PNL which will be added back. So that is 30,000 rupees. Next is provision for tax. It was 60,000 last year. Now it is 75,000. So trade payables is 1,70,000 in 2024. Now it is 2,10,000. So there is an increase in creditors. Now next is short-term loans payable. There is a decrease of 30,000, which means that we have repaid. Okay. Next is PPE net, that is net of depreciation, which has increased from 7,80,000 in 2024 to 9,50,000 in 2025, which means we have acquired. Next is investment in 6-month FDs. It has reduced. Okay, it means that for 50,000 worth of FDs, there has been a maturity. Now, trade receivables, they have decreased from 2,80,000 to 2,30,000, which means that you have received cash to the tune of 50,000 from the debtors. Next is there is an inventory. Inventory has also increased, which means that you have paid, okay, for the inventory. The last one is cash and cash equivalents, which has increased from 2 lakhs to 3,25,000 subject to adjustments. Now let's see the additional information. The first thing is net profit before tax for financial year 2025 is 2 lakhs. Again, depreciation on PPE is given. PPE worth 80,000 for WDV is also given, is sold at 90,000. So you need to calculate profit or loss. Okay. Next is PPE purchased includes 1,50,000 worth acquired by issuing shares. So by now you would have realized that the kingmaker in this question is going to be PPE. Okay, you have a considerable amount of adjustments where you need to take care of how much of it is cash, how much of it is non-cash, and how much of it is to be added to the profit and how much of it is to be reduced from the profit. Next is dividend receipt from investment in subsidiary. Interim dividend paid is 40,000. Interest received on FTs is given. TTC is also given. Interest paid on debentures is given. Debentures partly redeemed during the year. So it's not full redemption, it's a part redemption that we can see from the balance sheet itself. Now, income tax paid during the year is 55,000. Foreign currency bank balance increased from $2,000 to $2,200. Exchange rate changed from 75 per dollar to 80 per dollar. Now, they have given okay, that prepare a cash flow statement for Sapphire Tech Limited for the year ended 31st March 2025 using the indirect method as per AS-3 revised. Be careful to classify industrial dividend transactions accurately and disclose non-cash and foreign exchange impacts as per AS-3. Okay, see, the thing is that we know that we have two methods to calculate cash flows from operating activities, direct and indirect, right? So direct method will give you the operating cash flows directly. You calculate, add or subtract directly all the operating cash flows and arrive at the cash flows from operating activities. So most of the questions with direct method will not be much challenging, but the challenge comes only when there is no operating cash flows directly involved in the question. So you need to, track or calculate from the back using the net profit of the current year, and you have to add or subtract non-operating or non-cash transactions so that you arrive at cash flows from operating activities. So most of the questions in exams will be given based on indirect approach only. Okay, even though if the question did not mention, even if the question did not mention that calculate using indirect approach, we would have still calculated using indirect approach only because we don't have the operating cash flows directly. Okay, so now let's deep dive into the question. So we know, let's look at the given data now. We are provided balance sheet extracts for 2 years, that is 2025 and 2024. In addition, we have 11 crucial adjustments, including depreciation, asset sales, foreign exchange impact, and dividend or interest income. Okay, now the first activity or the first section of the cash flow statement is what? That's operating activities. Now let's derive what is cash flow from operating activities. Okay, now we are taking operating activities, right? Okay, operating activities. Now, the question here is they have given you net profit before tax. So that is what you have to take. Net profit before tax. Okay, so they say it is 2 lakhs. Net profit before tax is 2 lakhs. In my handwriting, it's actually a bit difficult to write it here. Okay. Now, next thing is, now we will adjust non-operating and non-cash adjustments. Then we will go back to working capital changes. So finally, we will arrive at cash flows from operating activities, right? Now, let's see. Depreciation. Depreciation is a non-cash item. So you add it back. You add it back because it is already included in this 2 lakhs. Okay. Now, interest paid. Interest is a non-operating adjustment. So it is already there. So you add it back. 50,000. Now, profit on sale. Profit on sale of PPE. Okay. So see, they say that the WDV of the assets is 50,000. Okay. But it was sold for 90,000. So the company earns profit of 40,000 on this sale of PPE. Okay. This 40,000 would have been credited into P&L. Okay. So it would be added into this 2 lakhs. Now you will be subtracting this. Then dividend received. Dividend received is a non-operating income. So dividend received. So dividend received is non-operating income. You subtract it, which would have been a part of profit. So you're subtracting it. Next is interest received. Same again. Interest received 30,000, which will be subtracted. Now, So if you say that, okay, now operating activities comes to, that is before adjusting working capital changes, net profit and the adjustments, they total up to 2,55,000. Okay, so they total up to 2,55,000. 10 should be cut, right? Sorry, 2,55,000. Now, so 2,55,000. Now we adjust for working capital changes. Working capital changes. Now, you're seeing that working capital changes. You know what is working capital, right? Current assets minus current liabilities. So you look at only items that are pertaining to current assets and current liabilities, right? Now you see trade receivables. Trade receivables decreased by 50,000. Okay. Now what happened? If trade receivables decreased by 50,000, it actually means that debtor has paid money to us. You have received. It's a cash outflow. Sorry, cash inflow, right? So you add trade receivables, you add it back. Okay, 50,000, you add. Now, inventory increased by 80,000. Inventory increased by 80,000 means you now have more raw materials. What does it mean? It actually means that you have purchased it. So inventory increase should be subtracted because you used cash to purchase those inventory, right? Next is trade payables increased by 40,000. Trade payables increased. Okay. Trade payables increased by 40,000, which means you have more money now. Creditor has given you more money. Now you have more cash. So you add it back. Now short-term loans. Short-term loans. They decreased by 30,000, which means that you have repaid short-term loans. So cash was involved. So the net working capital change is minus 20,000, right? Minus 20,000. So the cash generated from operations, cash from operations, ops, is net of, the sum or subtraction of everything, that is 2,35,000. Now, they also say, the tax paid, right? So less tax paid, that is 55,000. Now, cash flow, net cash from operating activities is 1,80,000. So we have calculated cash flows from operating activities. Now, let's come back. The next section of the cash flow statement is what? Investing activities. So the biggest thing that we have to see here is PPE adjustment. Okay. Because we have dividend, we have interest also, but the PPE adjustment takes the cake, right? Now let's see. Investing. Sorry. Investing activities. Okay. Now, PPE as on 31st March 2025 is how much? 9,50,000, right? Now, PPE as on 31st March 2024 is how much? 7,80,000. What is the net increase? Net increase is 1,70,000. So we think that this is the net cash movement, but not. We have a lot of adjustments also, right? So now you add depreciation for a year. How much? 1 lakh. It's given in the question. Now, since depreciation reduces the book value, we add it back to get the true addition. Okay. So now the adjusted PPE would be how much? 2,70,000. Now adjusted PP 2,70,000. Right? Now add book value of PPE sold. How much it is? We saw in the question. It was 50,000. This was already reduced. The PPE, this has already reduced the PPE figure. So we add it back, right? So it is 3,20,000. So I mean, I hope you're understanding. The thing is, we are actually calculating the entire PPE, okay? And we are reducing whatever is not through cash, right? So this is the exercise that we are planning to do based on this activity, right? Now what we are doing is, we will reduce PP acquired through non-cash means. Okay, PP acquired through non-cash means, that is by issue of shares. Here, if you can see the fourth adjustments, it says 1,50,000 worth of PPE was acquired by way of shares. So the final answer for it is, PPE net cash outflow is 1,70,000. See, you would have said closing minus opening is 1,70,000, but you will not know what are the adjustments that you have made. If you can see, so it may not be the accurate answer if you just subtract the closing minus opening and say it as 1,70,000. So the working note is very essential. So first, what we have done is, we have compared the net increase in PPE as per balance sheet, that is 1,70,000. Then we have added back the depreciation. Okay, because that was also a part of your PPE at the beginning of that year. We are adding it back. Then we are adding back the sale value, I mean the book value of the asset sold. So that was also a part of the PPE at the beginning of the year. So that we are adding back. So we are seeing at the end of this year, it should have been this much. Okay, but what happened is, we acquired additional PPE worth of 1,50,000, which is not part of cash flow statement because it was acquired through shares. The cash was not involved. So we are reducing that portion from the overall PPE gross. From that, you're getting 1,70,000. So this should be shown as cash flow from investing activities with respect to PPE. Now, what I'm trying to say is, now we have dividend received as well. Okay, so dividend received, dividend and interest and dividend, right? So dividend received is how much? 25,000. Okay, dividend received is 25,000. We have to add it back. It's a cash inflow. Now interest received is nothing but 30,000. Okay, now we are saying that, okay, we sold PPE, so that is also to be added. Sale value is 90,000. Okay, now the net cash, what is 170, right? So now the net cash involved was, the change was 1,70,000. Now the most important thing. So whatever we discussed, PPE actual cash addition, which will be calculated based on, what is the difference between what is addition from last year to this year? It is 1,70,000. See, 1,70,000. We saw it, right? We made the working note for the same. Okay, minus asset acquired through non-cash means, which is 1,50,000, right? So which will be 20,000 of outflow, right? The net investing cash flow is 1,25,000. So this is the most important thing. So we need to arrive at the working note See, working note should be given at last. Here I'm explaining, so I'm directly giving it to you. But actually, it should be given at last, and it should be arrived based on the work note. This is PP actual additions. So the change is 1,50,000, 1,70,000. Out of it is 1,50,000, which is through non-cash means. The only cash addition is 20,000. So cash addition of PPE should be considered as outflow. So that's why we are subtracting it. Okay, dividend received is a cash inflow, interest received is a cash inflow, sale value is a cash inflow. So we are adding it, and we will be reducing only the cash addition of PPE. Okay, now let's come back to financing activities. Financing activities. Now, the biggest thing in finance activities, as I already said while I was reading the question, share capital was increased by 2 lakhs, but 1,50,000 of that was non-cash. So we have to keep that in mind. So we have issued shares of 1,50,000 out of 2 lakh of total additions in share capital for purchasing PPE. So the actual cash inflow is 50,000. So this is what is most important. Actual the issue in cash is 50,000 only, not 2 lakhs. So this is the thing we have to understand here. Okay, now debentures were redeemed, right? So redemption of debentures, how much? Redemption of debentures is 2 lakhs. So it is cash outflow, right? Then interest paid on debentures, how much? 10%, right? So it should be 50,000, because at the end of last year, it was 5 lakhs. So you would have paid for the entire 5 lakhs. So interest on debentures, it's a financing activity. 50,000, it's also an outflow. Interest paid on debentures, dividend paid. Interim dividend paid is given in the question. Sixth adjustment is 40,000. That is also an outflow. Usually, financing activities will have a lot of outflows, except for further issue of shares or debentures. So they should be noted. Now, net cash from financing activities is how much? Net cash from financing activities is how much? It is negative 2,40,000. 2,40,000. Okay. Now, net cash from financing activities is 2 lakh. Now comes the adjustment of the question. So they have given you, we have used all the adjustments given in the question except for the last. So it says you have $2,000 to $2,200, 2024, 2025. Oh, so it was $1 was $78. Now it is 80 rupees per dollar. Now what changed? So if you multiply this, you get 1,50,000. If you multiply this, you get how much? 1,76,000. So this net increase of 26,000 is given in cash and cash equivalents. So if you see the cash and cash equivalents, it was 2 lakhs in 2024 at the end of 2024. Now it is 3,25,000 at the end of 2025. So this 3,25,000 includes this 26,000. This is not a cash flow. So it's excluded from the statement and shown in the reconciliation note. Do you understand? Because read the adjustment carefully. Foreign currency bank balance increased from $2,000 to $2,200. Exchange rate changed from 75 to 80 per USD. Okay, so this foreign exchange impact is all actually given in 3,25,000. Okay, but out of that, 26,000 is a foreign currency impact, right? So this is not a cash flow. So now what happens is, let's summarize. Summary is pretty simple. Summary is very simple. Operating cash outflow is how much? 1,80,000. Okay. Investing is how much? 1,25,000. Financing is how much? Minus 2,40,000. Right. Now, net increase is how much? Net increase is 65,000. This is net increase. Net increase is 65,000. Right. What is opening cash? Opening cash balance. Opening cash balance is how much? 2 lakhs. Closing cash balance is 2,65,000. This is net increase. Now add forex impact because it should not be a part of this, right? So 26,000. Now closing per balance sheet. So much? Yes, 2,91,000. It will match. The closing should match because if not for this forex impact, it would have not matched. Okay, so now we have handled the full-fledged cash flow statement, and we have had adjustments with respect to depreciation, asset sales, dividends, interest, and foreign exchange. Everything under AS-3. Okay, thank you for watching this session. Have a good day.